Most short-term rental owners think the only way to boost profit is by raising prices or getting more bookings. But what if I told you there's a way to unlock thousands in extra income without lifting a finger, working more, or charging gas an extra penny? It's hidden in the tax code, it's called depreciation, and it's something real estate pros have used for decades, but short-term rental hosts are only catching on. In this video, I'll show you how depreciation works, how STR owners can use it, and how it can be one of your biggest profit levers, especially now that 100% bonus depreciation is back on. So here's the concept. The IRS says your property wears down over time. Even if the market value goes up, the structure itself gets older. So to account for that, they let you deduct a portion of its value each and every year, as it's slowly losing its value. This is called straight line depreciation. For residential properties, you divide the value of the building, not the land, by 27.5 years. So if your building is worth $275,000, you can write off around $10,000 per year every year for the next 27.5 years. And this write-off happens automatically. It's built into the tax system itself. It's a paper loss. You're not spending money, you're literally just reducing your taxable income, meaning you pay less tax and keep more cash. Let's talk numbers. Your cost basis is what you pay for the property, plus things like closing costs, major improvements like new HVAC or a new roof, capital assets, washer, dryer or fridge. You get the picture. Now remember, land value isn't depreciable, it doesn't wear out. So if you bought the property for $350,000 and the land is worth $50,000, your depreciation applies to $300,000. Divide that by 27.5 and you've got $10,900 to write off every single year. But it doesn't stop there. The IRS lets you accelerate some deductions. And that brings us to the real strategy that real investors use, cost segregation. But this is where it gets powerful, really powerful. Cost segregation breaks your property into different parts, like flooring, lighting, and appliances, and depreciates them much faster. Instead of writing everything off over 27.5 years, some parts get written off within 5, 7, or 15 years. As of 2025, 100% bonus depreciation is permanent in the US, meaning you can fully deduct those short life assets in year one. Look, you will need a professional study done, usually by an engineer or a CPA to break this down legally. But if you're buying or re-renovating short-term rentals, this is the real play. We're talking tens of thousands in early year write-offs. Real estate pros have been doing this forever, but short-term rental hosts are late to the party, but it's never too late to get started. Now here's where short-term rental hosts often miss out. They assume depreciation only applies to long-term rentals, but if you're actively involved in managing your Airbnb or short-term rental, messaging guests, coordinating cleanings, handling bookings, you qualify for depreciation. And if you meet material participation rules, your short-term income might even be reported on Schedule C, unlocking even more tax strategies. This is huge if you're operating multiple properties or planning to scale. So let's do a real-world example. You buy a short-term rental for $400,000, land is $75,000, so the building is $325,000. Straight line depreciation gives you about $11,800 in annual write-offs. So if your short-term rental earns $50,000 in profit, depreciation reduces your taxable income to $38,200. You just saved thousands. Now layer in cost segregation. You do a study and find $60,000 in 5-year assets. With 100% bonus depreciation, you write off all $60,000 this year. That could reduce your taxable income to near zero, even if your property is cash flowing. There's one catch: depreciation on recapture. When you sell, the IRS wants you to pay taxes on the amount of depreciation you claimed on. It's taxed up to 25%, depending on your income. But don't panic, here's why. The money you save now can be reinvested and grow faster. You may qualify for a 1031 exchange, deferring those taxes entirely if you reinvest in other rental. A good CPA can really help you plan around recapture years in advance. You don't have to be an expert, you just need to use the rules that already exist. Understanding depreciation isn't just about saving on taxes, it's about keeping more of what you earn. and that unlocks growth. Every dollar you keep is a dollar you can reinvest in renovations, marketing, hiring help, buying a net short-term rental, and so much more. Depreciation is how short-term rental investments turns a side hustle into a real business. And with 100% bonus depreciation now extended permanently, there's never been a better time to use it. If you're running an Airbnb or short-term rental and not using depreciation, you're leaving money on the table. Talk to a tax pro, ask about cost segregation, and start tracking everything. The tax code was built to reward property owners, so use it. If you found this video helpful, hit like, subscribe to our channel, and make sure to check out our other videos on building smarter short-term rental income.